Support and resistance. Support and resistance are lines or levels on a technical chart which indicates the highest and lowest points within a specific period of time or time frame. Every point at which the market turns is known as support and resistance levels. These levels produce clear indications of where the market will change direction and create clear opportunities to buy or sell. To draw support and resistance lines or levels on a chart, one has to identify past levels as the market tends to move towards past support and resistance levels. These levels can be found on any time frame. So as we zoom in to the picture that we have below, I can actually show you various support and resistance levels on this candlestick chart. So as you can see on this end over here on the right hand side, we've got the current price or most recent price of the specific currency pair. Anything on the left hand side is considered the history or the past data. So on the far left hand side, you see that the market came down, then the market formed a railroad, as you can see there on the candlestick patterns that we just discussed earlier, and the market found support over here, formed the railroad, gave us a signal that the market is starting to go up. The market then turns bullish and moves upwards. The market then finds some resistance over here on top, and the market now forms another candlestick pattern, and then the market starts to turn bearish and moves downwards. As you can see over at this point, the market moves downwards. It is now in line with its previous support level. Right? However, it breaks past that level and continues down to a support level which is much lower, which would also then be a different support level further back in the history. The market then forms a reversal pattern, bounces off the support level and turns bullish. Market then moves up to find resistance over here on the top, forms a reversal pattern, turns bearish and moves all the way down to find support over here again. Right? So this was your buying opportunity and this was your selling opportunity. The market then finds support and moves upwards, right, and finds the resistance over at this level over here. This specific level of resistance is in line with its previous level of resistance. So if you were to buy at this point of support, you would have then bought and set your target for this level of resistance, because we have a clear past indication that this is a strong resistance level at this specific price point. So we would then set our target for this price point and not any higher, because there's a chance that the market would stop around here. And as you can see, the market did stop around this price point and found resistance once more. The market then formed a reversal pattern and dropped down to find support in this area over here. As you can see over here where it finds support, we also had previous support just over there. So you can see how the market comes and falls down to where the market found previous support as well. So support and resistance levels will forever stay on your chart as specific price points as to when to enter the market and also where to start taking profits out of the market or setting your targets. As you can see, we bounce off the support level and we move up to once again reach this zone of resistance. However, this time we break through and the market decides to turn back and try to enter this zone of resistance again. The market, however, cannot, right? And because it cannot come back through, the market now finds support at what was a previous resistance level. So now this old resistance becomes new support, and this is a perfect indication to enter the market for a buy. So that is the basics of support and resistance. So as we go further, it goes to say that in this picture above, you can see that we identified and mapped out past support and resistance levels. This is important as it helps you identify how near or far to a support and resistance level the current market is in order to make properly informed buying and selling decisions. Look at the last support levels before the market reached this level. It was previously at resistance levels because you can see it falls within the same area as previous resistance levels, right? When the market reached this point, it then pushed further and broke through. So that's what I just explained now on the picture. This level is now no longer resistance, but now becomes support. And that's the level where you can obviously now find buying opportunities, right? So it goes on to say that because we are on a support level, we can now look for buying opportunities. The opposite could happen for selling opportunities. Okay, let's go further. Bullish and bearish rejection. Okay, bullish and bearish rejection. When the market reaches zones of support and resistance, the market will often move sideways for a while and form what is known as bullish or bearish rejection. This happens when it is a very strong support or resistance level and the market struggles to break through these levels. During an uptrend, the market will hit a level of resistance. The pattern that sometimes forms is seen as bearish rejection, as the bears or sellers are forcing the market downwards. The opposite would happen in a downtrend. This is seen as bullish rejection, as the bulls or buyers are forcing the market upwards. So over here we can see that this is a bearish rejection pattern. You see that the market has come up to hit this resistance line and it is hitting it multiple times, but it fails to break through this resistance line. After that, we then form a very big bearish engulfing candle, which indicates that there is strong momentum downwards, and this will now be seen as a selling opportunity. Over here on the bullish side, we've just got the opposite happening. So the market came down to hit this support line, failed to break through this line multiple times, where we then formed a very big or strong bullish engulfing candle, which indicates strong momentum to the upside, which indicates buying opportunities. So it goes on to say that in an upwards trending market, previous resistance becomes new support, and in a downtrending market, previous support becomes new resistance. It is very important to identify these levels correctly, as it will be necessary to help you enter a trending market at the right moment. These support and resistance levels are also known as swing high or swing low when in a trending market. When the market forms a swing high, pulls back, it pulls back down slightly and then moves higher. This is then called a higher high because it is higher than the initial swing high. When the market forms a swing low, pulls up slightly and moves lower, this is then called a lower low because it is lower than the initial swing low. So then I've got this highlighted for you over here in red. It says do not enter a buy trade close to a resistance line. Right? Do not enter a buy trade close to a resistance line because the market will need to break past that resistance in order for it to then turn into a valid support. That is when past resistance becomes new support, and then only we can look for buying opportunities. When the market hits the resistance line, it still stands as a valid indication for selling, and then we wait for a candlestick pattern or confirmation of momentum to start selling. Then it says do not enter a sell trade close to a support line. So that's the exact opposite. As we come down and meet a support, that is an indication that the market might reverse and turn into a buyer's market or a bullish market. So we do not want to sell close to the support line unless we break past the support line and retest it somehow and then pull down further and continue momentum to the downside in a bearish trend. Uptrends and downtrends. So we've got an uptrend and downtrend. As we can see over at this point where the cursor is at, the market starts moving up to this point over here. This is known as the initial swing high, right? This is a low point and that is a high point, so the market is swinging up high. The market then pulls down slightly to form a swing low, then moves up higher past this previous swing high to form a new swing high, moves down slightly, forms a swing low, right? And then the market once more continues upwards to form another leg to the top as a swing high. So when the market has a low and forms a swing high, this is then known as a low and a high. When the market pulls down slightly, the market now forms a lower high, right? Because this point over here is still higher than the initial low, but it is lower than this high, so it is a lower high. The market then moves up to this point over here where we form a higher high because this point is now higher than the previous high point that we've got. The market now pulls down to this point over here where we form another lower high because we are lower than the previous high, than the new high, and then the market continues upwards to obviously form a new higher high. Over in the downtrend, we've got the inverse happening. So we've got a high point, market then moves down and forms a low point. So we've got an initial swing low that forms over here. The market then moves up slightly to form a swing high, moves down to form a swing low, up slightly again for a swing high and continues downwards. So over here we've got a high point and we've got a low point. The market then moves up to form a higher low because this high is higher than this low over here. The market then moves down to form a low point over here where the swing low is, which is now called a lower low because it's lower than the initial low over here. The market now moves up to to the swing high point to form a lower high because we are lower than this high over here. Then the market continues downwards to form a new lower low, which would then be lower than this initial point over here. Right? So now we can continue on to the next few pictures, which shows us support lines, resistance lines, and how support lines changes into resistance lines. So over here you can see that this essentially is a bullish rejection pattern that's forming here. You can see the market came down to hit the support line 3 times, failed to break it on the third hit over here, right? And the market went and shot upwards into a bullish pattern. Right, so this support line was very strong and held its ground. Then we've got a resistance line where the exact same thing happened. The market came up to hit this resistance 3 times. On the third hit, the market then decided to continue downwards into a bearish trend. Right, so this was a very strong resistance line that could not be broken. So this was buying opportunities, this was selling opportunities. Over here, we've got a support line where the market comes down to hit the support twice. The market moves up, and when it comes down to hit the support on the third time, the market, however, does break through the support line. Right? The market then bounces back up to retest the support line to see if it can re-enter this zone. However, the support line now stands strong as a resistance line, right? So the market comes down to hit this resistance line for a second time, right? To test it for a second time to see if it can enter the zone again. The market fails to do that and now continues downwards into a bearish trend. So this now forms selling opportunities. That's why we explained earlier to not sell close to a support line, right? Unless it breaks through the support. Do not buy close to a resistance line unless it breaks through the resistance line and the market turns bullish.